Good afternoon. Welcome to this edition of the SCR webinar series. Joining us today is Lisa Sharrad Jones with Choice Flood Insurance. Lisa has extensive knowledge of flood issues with more than 28 years of floodplain management experience and insurance under her belt. She has served in positions such as Chair of the Association of State Floodplain Managers, SE's Flood Mitigation Coordinator, and FEMA's Flood Mitigation Assistant Grant Program and Project Manager, among other positions. She has done numerous webinars for SE Realtor members and is here with us today to offer valuable information regarding FEMA flood map changes and flood insurance in South Carolina. Thanks for being here today, Lisa, and sharing your knowledge on this very important topic. Now I'll hand it over to you.
Fantastic. Thank you. Welcome everybody to today's webinar. As you noticed, my company name has changed. It's Choice Flood Insurance, and yes, that is true. I have opened up an insurance agency and I only sell flood insurance. And so I'm bringing this webinar to you today, sponsored by my new company. I'm still operating as a consultant with Carolina Flood Solutions, and which is also changing its name to U.S. Flood Solutions, and we'll talk about that a little bit later. But welcome everybody, and I hope you enjoyed today's webinar. A lot of people are involved in the mapping process and in the National Flood Insurance Program, so we're just going to kind of go through an overview for some people who are new to the NFIP, which stands for the National Flood Insurance Program. FEMA is part of the process. They don't control the process. The process is controlled by Congress. Congress sets the regulations, which involves multiple federal agencies. FEMA is the administrator of what Congress tells them they have to do. So FEMA works with the Write Your Own companies, which you see there the acronym WYO, and the insurance industry. They also work with floodplain managers, state and local governments, and run the mapping program as well. And then the mortgagees, the mortgage banks, they implement what Congress does as well. So they're the people who force place policies, who say you have to have flood insurance when it's required. And they have their own set of rules and regulations they have to follow to meet Congress's directives. So it's more than just FEMA. FEMA doesn't drive the train, they're just the messenger. So everybody remembers the Big Waters Flood Insurance Reform Act of 2012. That basically set in motion the elimination of pre-firm subsidized rating and set up a firestorm of within the real estate industry. It implemented increases, 25% increases for non-primary residents, and it really forced older buildings to be rated with an elevation certificate if that policy had been sold, and that was reversed later through the through a later act we'll talk about in a minute, Homeowners Flood Insurance Affordability Act. But lenders were fined $300 per loan, and those fines were increased to $2,000 per loan with no limits. And so in February 2015, FEMA withdrew their mandatory purchase guidelines because what Congress had done had superseded. So we really don't have any guidelines out there right now. Everybody's trying to figure out who has to do it. But the mortgage industry is the one who driving the train as far as mandatory purchase. The lender's flood zone determination is the primary. So regardless of what you think or what your surveyor thinks, the lender's determination is the primary determination of whether or not flood insurance is going to be required. We're going to talk about flood zones, and I want to kind of go through what those flood zones are. High-risk zones are any zones that begin with an A or a V. Those areas are noted as special flood hazard areas. Anything that begins with an A or a V flood zone is going to be required to have flood insurance. Anything that begins with a B, C, or X flood zone is a non-special flood hazard area or an area of minimal flood hazard. And notice that I said did not flood. All areas are subject to flooding. Some are higher risk, some are lower risk. But every property in South Carolina is in a flood hazard area. It's either a high risk or a low risk. Everyone has a flood zone. So we're also going to need to talk about a couple of phrases I'm going to go through is pre-firm and post-firm. Pre-firm means that the structure was built prior to the initial flood insurance rate map becoming effective, or December 31st, 1974, whichever is later, and has not been either substantially improved or substantially damaged. And that word substantially implies 50% or more of the market value of the structure. Either damages equals or exceeds that, or the improvement equals or exceeds. Post-firm are structures that were built on or after December 31st, 1974, or the flood insurance rate map in effect for that community. So how do I know what that date is? What's the post-firm date for my community? If you go to the community status book is one place you can look. That's available on FEMA's website. If you just Google FEMA Community Status Book, you'll see that there's a table there, and you'll see that it has the name of a community, a county, and it'll have the initial firm date, the current effective firm date, and the firm is a flood insurance rate map. That initial firm identified date tells you what that pre and post firm date is. If it's on or after that date in this column that you see, it says initial firm identified, then it will be post firm if it was built on or after that date. Another place that you can look is on the map index. When you look at a community such as Richland County here shown, you'll look at the map index. And on that map index at the bottom there'll be a table with a listing of communities. And it will show you that initial firm date, the date that it was identified. So for Arcadia Lakes, South Carolina, the initial firm date is November 19th, 1960. For Blythewood, it's September 29th, 2010. And that would be the date of their initial firm date. Why are they much later? And they're much later because that would be the date that maybe they incorporated later, or the map, the flood map had not been identified for that community until that time. So although it seems like recent history, that is the initial firm date for that community. So what difference does it make? Under the Flood Insurance Reform Act, you can save over $90,000 over a 10-year period if you build 3 feet above the base flood elevation. So this is just a diagram that shows you, an image that shows you visually, if my structure is 4 feet below base flood elevation compared to 3 feet above, what the savings is going to be over a 10-year period. So I always encourage everybody to build a minimum of 2 feet above base flood elevation, which is what most local governments require. However, if you build 4 feet above base flood elevation, you're going to have a significant savings over time. Most people who had to elevate their houses or chose to elevate their houses after the October 2015 floods here in South Carolina are choosing to elevate their houses 4 feet above to maximize the insurance savings. They look at the economics over a 30-year period of the time that they feel like they're going to own the house, and the numbers worked out. If you have any questions, there is a way for you to enter questions. You want to tell them about that as we go along? Okay. So just type in your question and we'll be happy to answer them. So elevation rates versus the pre-firm subsidized rates. Pre-firm subsidized rates are going up 25% a year. So over time, those rates are going to skyrocket. And elevation rates are based on the elevation in relationship to the base flood elevation, elevation of the lowest floor of your house or structure in relationship to the base flood elevation at that time. And we'll talk about grandfathering as well. But the cheap can come out expensive. You think you're going to skimp on, well, I don't really want to have to comply with the regulations. I think they're foolish. I don't want to elevate 2 feet above. I think I'll just, elevate to what I think is right. Or I don't want to elevate at all, so I'm just going to do a repair and I'm going to skirt the substantial improvement guidelines. Your flood insurance premiums are going to go up over time. So if you were pre-firm subsidized and you chose not to elevate, make a repair, then you're going to pay for more for insurance over time. The Homeowners Flood Insurance Affordability Act in 2014 came along and rescued the real estate transaction market at the time. Biggert Waters said if you have a real estate transaction, you get a full risk rate at the time of closing for your flood insurance, and the Homeowners Flood Insurance Affordability Act reversed that. And that really went back retroactively and restored all the pre-firm rating for new policies that were bought or sold after July of 2012. Placed an 18% cap on premium increases for most policies, and it issued refunds for those properties that had been affected by a sale or closing at the time between the Bigger Waters Act and the Homeowners Affordability Act to let them go back and refund those premiums that they had bought a policy and were paying those exorbitant premiums. But it left in place the 25% increase for non-primary residential and commercial buildings rated as pre-firm subsidized. It also increased the deductibles amount. So now we have like a $10,000 deductible which you could have. And there are surcharges that are going to be applied to all policies and they're being applied now to make up for that premium rollback. So what do I mean when I say subsidized rate? And a subsidized rate is that rate that was not really, they're not paying as if they're built today. They're really being subsidized because it's older construction. The older construction was not, there was before a flood map, or we knew what the flood risk is for that community or for that area. So it's really for structures that were built prior to a flood insurance rate map. Full risk rate is that rate that if they were to new construction, what is that rate going to be? And so today, so if we built that house today and it was built in compliance, you know, that's the full risk rate. So if we had an elevation certificate and it says that they're 5 feet below base flood elevation, we're going to rate it as 5 feet below base flood elevation. And so what the goal is of the program is to go from the subsidized rate gradually, with staying within the cap of 18%, to the full risk rate over time for those structures that are older, what we call pre-firm. The other thing that was affected was the primary residence. Primary residence is a single-family dwelling. It's going to be lived in for 50% or more of the year, either by the named insured or the named insured spouse. As long as there's no lapse in coverage, they can maintain that pre-firm policy in effect. Now 50%, it says, you can see the red arrow there, says lost settlement impact. You can live someplace 50% and declare it your primary residence, but the claims process says principal residence, and principal residence means you live there 85% or more of the time. So if you live there between 50 and 85% or less than 85% of the time, then you're only going to get actual cash value at time of loss, at the time of a claim, versus if you live there 85% or more, you would get replacement cost value. And this only applies to single-family residences. Replacement cost value is the cost to replace that home if it was built new today without any depreciation. It has to be your principal residence in order for you to get that, and you have to be insured 80% or more to the replacement cost value. So if you have a $100,000 structure, the replacement cost value is $100,000 for the structure, then you would have to have at least $80,000 worth of flood insurance coverage in order for you to get replacement cost value. Pre-firm businesses. This is another category that's impacted by the flood insurance acts. Their property that insured as non-residential, and beginning April 2016, those rates increased 25% a year until they hit full risk rate premium. So this is kind of a snapshot here. The average rate classes for pre-firm structures, and again this is pre-firm, is going to be limited to 15%. Individuals are listed 18% per class, and then the mandatory increases occur under the purple arrow there for pre-firm subsidized policies that are either non-primary residence or second homes, vacation homes, repetitively flooded buildings, buildings that have been substantially improved, or businesses after 4 April of this year. A business is defined by FEMA where it's a for-profit. It's not a business that is used for human habitation. It could be a mixed use. It could be designed as an office space, retail space, wholesale, hospitality, or similar use. But it's really designed where you have a commercial enterprise being carried out to generate income. And so this, for the purposes of business, FEMA is going to be charging, because Congress told them to. Remember, FEMA is the administrator, charging increases for 25% each year for a business that's pre-firm and showing as pre-firm subsidized until they hit that full risk rate premium. The other thing that's going to be happening this year in October is the companies are going to be implementing Section 23 of the Homeowners Flood Insurance Affordability Act. And that means that FEMA has to communicate clearly the information on the declarations page. A lot of people have said, well, I'm grandfathered, but on my declarations page of my policy, it says no. So the companies have to answer that question correctly. So the first step that they're going to have to do is they're going to go back and they're going to look at the maps and determine the current effective map. And they're going to look at how the policy is rated. They're going to go back and look at the map that you're rated. If you were rated under a previous map, they're going to make sure that you were entitled to be rated under that previous map. There is no time limit for them to go back. They will go back for the entire history of the policy. This could result in premium increases if you were being grandfathered and not entitled to it. It could also result in refunds. I have run into people who have been told that they are not entitled to the grandfathering and they've lost the grandfathering and been rated based on the map that was in effect at the time they bought their policy, and we've had to go back and recreate the documentation to substantiate the original rating, to have that restored. It's complicated and it's a lengthy process. It's not done in 10 minutes. For some of these, it requires a lot of research, but it can be done. So if you come across properties that are being re-rated as you are during the process of while you're listing that property, reach out and see if we can help you with that. This is a maps basically of what's going on in South Carolina with the maps. The blue areas are where we have preliminary maps out or studies in progress. And there's a more detailed listing here of the preliminary maps that have been issued in South Carolina. I do not have a listing of when the appeal periods for these times end, but this is available and you'll get the address where this information came from. But this is all of the preliminary maps that have been issued in currently in South Carolina. And then here's a listing of the current effective maps. The final products have been recently issued. Greenville County was issued in 2014. But the newly mapped procedures, and this is really important. So what happens if there's a map change? There's a number of things that can happen. There is either going to be no change, everything's going to stay the same. We're going to have a change where the property moves from a high-risk zone into a low-risk zone, or it could move from a low-risk zone into a high-risk zone. We also have something called a coastal A zone, and that's going to be appearing on the map. There's really going to be no difference other than they are just showing where there's going to be wave action. Communities that participate in the community rating system will be required to, for new construction, implement standards for V zones construction in those coastal A zones. They'll be designated as a LMWA zone or area of limited wave action. There could be a change in the BFE or a vertical datum. You're really not going to notice if there's a shift in the vertical datum. That's kind of something that the surveyors would notice, not really you would notice in it. But those, those are the things that could happen with a change. With a flood map change, the BFE could go up or it could go down. You could go in a flood zone or out of a flood zone, high-risk flood zone, or there could be no change at all. How do you find out what the changes are? If you're in one of the communities that has preliminary maps, go look at your flood maps, the preliminary flood maps through your local government, or you can look at them on FEMA's website. But again, the properties that were in BC or X zone that have been remapped into a zone that starts with an A or a V are going to come under the newly mapped procedure guidelines. So if you're one of those properties that are in a BC or an X zone, if you look at my graphic here, in 2014, and your map is going to be effective, the new map for your community is going to be effective, say, 3/31/2015. You want to go buy a PRP policy or preferred risk policy at least 31 days in advance of that map date. So by the end of February, you want to go buy a policy. And the reason being is that when that policy renews, you're going to get an additional year of a break in your premium. So you're going to get paid $405 for your flood insurance policy, and it's going to renew at that. If you wait until later to buy that policy, you're going to have to pay the newly mapped rate, which is going to be $455. So you're going to get a whole year of that cheaper premium at full coverage. And so when the policy renews this on year 3, you're going to get in that newly mapped procedure, and you're going to start paying an increased rate until you hit the full risk rate premium. So eventually that rate's going to climb. And so this is a way to ease you into having to pay flood insurance rather than saying, oh, you got to buy flood insurance and now that policy is going to cost you, $800. And so rather than having to put $800 out of your pocket, the first year, they're going to ease you into that by with this newly mapped procedure. But the goal is over a 5-year period to have you paying the correct rate. Grandfathering. If you have a flood insurance policy in effect, you're going to be grandfathered if the structure was built in compliance and with the flood insurance rate map at the time of construction. That means you had to have a flood insurance rate map at the time of construction, or you've had an NFIP policy since you were eligible to purchase one. So in other words, if you have a pre-firm structure and you've been a good loyal customer to the NFIP and you've maintained that policy, then you're going to be recognized as having grandfathering. But the key is to have no lapse in coverage during the time that you've maintained that policy. It has to be continuous coverage. And private policies, private flood insurance policies, do not qualify as continuous coverage. So for example, with this emerging private market policy, if you have an NFIP policy and you decide, I can get a cheaper deal in the private market, and you go to the private market, and then for some reason they drop you, and you want to go back to the NFIP because it's the only game in town, you're going to go back at full risk rate premium if you have a mortgage because you've lost your eligibility for grandfathering. There is a workaround that until the law is changed, and if you need help with that, please give me a call and we'll figure out the workaround that best suits you. There is a 30-day waiting period unless there's a loan closing or a map change. With a map change and flood insurance is being required by the lender, there is a 1-day waiting period. So it's very important to understand this, because once you see the hurricane off the coast of South Carolina and you don't have a mortgage transaction happening, you're going to have to wait 30 days for that policy to be in effect. So at that point, it's too late to run out and buy a policy to cover you for this storm event. And that's in Congress's intent, because people were going out, seeing the storm off the coast, buying the policy, and then when people left, when the storm left, then they would drop the policy. And they had a big fluctuation around storms, but and it was creating havoc on the program and the long-term sustainability financially of the program. So they put in this provision of a 30-day waiting period. This is very important. South Carolina law requires producers and agents to be licensed. If you're an insurance producer, either a resident of South Carolina or a non-resident, say you live in California and you decide you want to sell flood insurance in South Carolina, you have to be licensed by the state of South Carolina. Not only you, but the agency you're selling on behalf of also has to be licensed. So someone coming from California who wants to sell you a policy, take a look at the Department of Insurance's database and find out if the people you're dealing with are licensed in the state of South Carolina. If they're not licensed in the state of South Carolina, that's going to be a problem for you if there's a problem with the claim or the agent, because they're not being, the Department of Insurance has no leverage against them if they haven't been licensed. They don't even know that they're writing business in South Carolina unless they're registered with the state. And it's very simple to do to get registered as a non-resident agent. I'm licensed in several states. as well as my agency. But you have to be licensed in those states in order to write flood insurance in South Carolina or most any other state. You have to be licensed as an agent and as an agency. So just remember who you're, to look up who you're doing business with and make sure that they are licensed. All of South Carolina is in a flood zone. And again, you just want to make sure that, that you have flood insurance, even if you don't think you need it, because 25 to 30% of all flooding occurs in low to moderate areas, risk areas, where lenders don't typically require flood insurance. And unless you're a licensed general lines insurance agent, you defer your client's questions to an insurance agent. Don't try to answer insurance questions because that's really outside your area of expertise. So this is an example of one of my clients who asked his agent, should I mitigate or should I not mitigate? And what, as you can read here, the agent was more interested in selling him a private market policy than answering his question. Because what they found here is if you completely fill in your basement with concrete or dirt, you'd have to elevate your house by 4 feet in the front, 6 feet in the back. This is probably not a realistic solution. Why would you want to do that, really? Gentleman had 6 feet of water in his house. Why would he want to elevate and not let this happen again? But if you are thinking you're paying too much, let me just move you to a private market policy and we'll get you a reduced rate. So the gentleman was paying close to $6,500 a year for his flood insurance. For the full risk rate premium for his structure was $3,589. Had the agent bothered to read the elevation certificate, they would have realized that he was misrated to begin with. The maximum he should have been paying was $3,589. They should have started generating a refund at that point, but they didn't do that. They didn't bother to do anything. The full risk rate premium, if they bring the structure into compliance and elevate by 2 feet, is going to be $547, and if they elevate by 4 feet, it's $490. So which premium do you think they want? They want the cheapest possible premium. So this gentleman is elevating 4 feet above the base flood elevation. I want to announce to you that Carolina Flood Solutions is now going to be U.S. Flood Solutions, because as I've been working around the country, everybody says, oh, Lisa, do you work outside of South Carolina? And I said, yes, I do. So we've just made it easier for them to understand. And it's U.S. Flood Solutions. The Carolina Flood Solutions website will take you to the new website if you have that link saved. And this is the new website address, and the telephone number is the same. I've also opened up an insurance agency. And you look at there, you can go to www.bfloodsmart.com, simple one to remember, and you can do your own insurance quote or get a free flood zone determination. You can also purchase flood insurance, also sell excess lines flood insurance, which means if you have a structure, the most you can buy through the NFIP is $250,000, you can purchase up to $1.2 million in excess coverage. So this is the BFlood Smart website. You can look there and you see that red box. You just click on that box that says, let's get started there. And that will take you to my website. And you're going to click the Get Started button here. And that's going to start the process for you to generate a quote. As you can see in the red box on the right is my telephone number, or you can click that, you can send me an email. But you have to enter this information in here first and click Next to start this. So I just make it simple, just went ahead and entered my name and telephone number. And so as you go through this process, you'll see there's a quote number over there on the right. It has your information underneath mine, and that has a quote number. And that quote number lets me reference what you're doing, so I can pull it up and work it with you. So you're going to answer very few questions here to let's get this started on the flood zone determination. So your information, and you'll see it there in the box there, is listed, but it's also where's my building located, and this is where you're going to enter the property address for the property you want to know if it's in a flood zone or not. And then you're going to click Next. And if you look down on the bottom right-hand side there, and I put in an address in Woodlake and a quote number, and you'll see it's in a high-risk flood zone. And you're going to add, so let's go back to the slide here. You're going to see information about the building type. Is it a severe repetitive loss property? Is it a condominium form of ownership? Does it have an attached garage, or is it a mobile home or travel trailer? And you're going to answer those questions. You're going to click next. This box here, if you click that down arrow, it's going to give you the flood zone, the community number, and the map panel number. That's all the information you need for your MLS listing. When we continue on doing the quote, what percentage of the building will be used for residential purposes? And you're going to answer this question here. So if you go through down here, 100%, 75 or more, and it gives you some helpful hints on the side there for notes. It wants to know the details. How many living units does it have? Do you own the building, or is the building going to be your primary residence? And what is the replacement cost of the building? So you want to fill out all those. And then you're going to say, well, what year was it built? Is it on the historic list of or inventory of historic places? Has it been substantially improved? Has there been prior coverage on the policy? A buyer who's interested in the policy would answer no, because they've never had a policy on a structure they didn't own. What kind of foundation does it have? Say it has an elevated building like they have at the coast, it's going to click other, and it's going to ask you for the number of floors, and it's going to give you some notes below you need to answer, use to answer. And then you look at the right. Once I click to the right, it's going to ask me how many floors, including the crawl space or enclosure. And then it gives you some foundation details. It wants you to kind of pick, what's the foundation look like? And then you're going to pick that. Does it have reinforced concrete shear walls, reinforced masonry piers or columns, piers, piles, posts, solid foundation walls? And then when I click piers, posts, it's going to ask me if it has any enclosure, what's it made of? It's going to ask me for details on that. Is there a mid-level foyer to the building? On the garage information, if you answer masonry, wood walls, solid frame walls, or other, it's going to ask you the following questions. Is the garage finished? Remember we said finished last time, said does it have more than 20 feet of drywall in place? Is the garage used for another purpose other than building access, parking of vehicles, or storage? And they want to know the square footage of the garage. These are all things that you should know as the insurance agent, be able to answer simply. Is there an elevator? Are there flood vents in the garage? Are there appliances in the garage or in the building? And this is in that area underneath the elevated building, not upstairs on the living floors, but in that area that would be below the base flood elevation. They want to know about machinery or equipment beneath the elevated floor or in the garage. Do you have an elevation certificate? Which version do you have? And does the property address match? And so they're going to ask you for some information on the elevation certificate details. And you're only going to answer those questions from what you see on the elevation certificate. Like, what is the base flood elevation? You're going to get that off of question B9 on the elevation certificate. And when you look at the sections on there, on section C, top of bottom floor, that's C2A. The top of next higher floor is C2B. The mid-level foyer foundation is not there, but the mid-level foyer could either be C2B, that could be the represented there. If you don't know, just leave it. Bottom of lowest horizontal structural member is going to be there only for V zones. If the structure's not in a V zone, there's not going to be anything for you to put there. Does it have an attached garage? And if it does, then you're going to have to put in the elevation of the attached garage. So this is where you put all that information in. And then it's going to say lowest floor for rating. If it has openings, you're going to use C2B. If it meets the openings criteria, you're going to use C2B. If it doesn't meet the criteria for openings, then you're going to put C2A. it's either going to be A or B, or if it's in a V zone, it's going to be C. However, whatever you enter, if it's incorrect, will get caught during the underwriting process. Or you can call me and I'll take a look at it. I'll be able to look at these as you go through them. If you have machinery and equipment inside an enclosure, the building's enclosure, then you're going to enter that information. If the building is the HVAC unit sitting outside the perimeter of the building, don't enter it. You'll know what that is when you read the comment section. The surveyor is supposed to tell you what it is and where it's located in the comment section on the second page. If there's a problem with something you answered, some inconsistency or discrepancy, they're going to go back and ask you to adjust your information. You'll get a box come up like this. Or you can contact me because that box is still over there on the right-hand side. But if everything goes through, it's going to tell you what the premium is going to be. And this is estimated premium because it's got to go through underwriting review. They're going to ask you to pick your deductible amount. So if you typically now I'm seeing a lot of $5,000 deductibles for both building and contents, and that'll lower your premium. So then your complete quote, once you get through this whole process, is going to be $658. And you can purchase the policy at that point if you want to. Again, it's got to go through underwriting review to make sure it's right. You're always welcome to email me and let me know that you've completed a quote and you'd like me to look at it before it goes to underwriting review, and we can make sure it's right and that you have the appropriate premium. It also allows you on the bottom right-hand link there, upload document. If you have an elevation certificate, you're going to want to upload that document under helpful links. If you have any information that you think I need to see, like a current policy, if there's a policy that the seller has on the structure, you can upload that as well. Again, there's a 30-day waiting period unless there's a loan closing. And at this point, we've concluded the presentation. You now can get free flood zone determinations and free insurance quotes at your leisure, 24 hours a day, 7 days a week, and I'm